1 million cover in the future is worth less now because of inflation. So give you an example, if our inflation is 3% a year,
Okay.
your 1 million death cover in 24 years time is actually worth half a million to today's dollar. Okay.
Welcome to another episode of 10 Must Know Insurance Tips Agents May Not Tell You. I'm Jayla, Experience Specialist, and this is Eddy, Haven CEO and our favorite insurance expert. At Haven, we believe that insurance advice should be clear, not confusing, and always aligned with your needs. I'll ask all the questions that we always wanted to ask, and Eddy will answer them. As a layman myself, I promise I'll keep asking until I get it. We hope this video helps you make wise insurance decisions without overpaying for coverage. So let's dive into today's topic. So today we'll be talking about insurance coverage, and there's been a lot of talks going on about how inflation is going to affect somebody's insurance coverage. So what are some of your thoughts about this?
Well, when we talk about insurance needs, right, there are actually many factors, and inflation is actually one of them. So inflation in gist means that things becomes more expensive over time. Alright, the same item become more expensive over time. Or another way of saying is that the same $1 you have in the future is actually worth lesser now.
Okay.
Yeah, because of inflation.
Okay, so am I right to say, in a very layman term, to make it easier, that let's say 10 years ago, a plate of chicken rice is about $2. And right now, today, it's going to cost us maybe $5 for the same plate of chicken rice.
That's right.
So as the year goes by, the value of our money is lesser and lesser.
That's right. Yes,
Okay.
precisely. Your example is very good.
Okay. Okay. So then my first question would be, in relation to the death coverage, right? How can the inflation actually affect the value of our coverage over time?
Well, because the inflation actually has the effect of reducing the value of reducing the dollar value over time.
Okay.
So what it means is that 1 million cover in the future is worth less now because of inflation. So give you an example, if our inflation is 3% a year.
Okay.
Okay, a year 3%. Your 1 million death cover in 24 years time is actually worth half a million to today's dollar. Okay, so in a way, the same amount of money, the same dollar value of money actually is worth lesser over time. Yeah,
Okay.
because of inflation.
Okay. Then is it necessary to buy extra death coverage to protect against inflation?
I think when we think about inflation and death cover, it is not so straightforward. But the simple answer is that yes, inflation is important to consider because it affects the value of money, the value of insurance coverage. However, how much you need actually changes over time. Your needs for insurance changes over time, not just because of inflation. It could be because of your life stages, because of your needs. Okay, when you started working, you may not have a lot of dependents. You don't need to cover a lot. But as you progress in life, for example, getting married, have kids, the amount of coverage you actually need to provide actually increases over time. Okay, and this will continue until a point whereby towards the retirement, the needs of that cover will decrease all the way to zero. Okay. If you are using income replacement as an approach in death cover, so your needs actually goes up and comes down as you retire. So what it means is that when you are retired, all right, there's actually no need to replace income in the event of death because you have already accumulated your retirement asset. Right? Death cover then will be a extra, not so essential, unless you have a legacy gifting to your loved ones. So our insurance needs actually changes over time, and that's why you need to factor that in.
Okay.
Inflation is actually one of the components.
I see. Okay. So then, are there more effective ways to mitigate inflation risk without increasing death coverage?
So if let's say the hypothetical scenario is that you need 1 million death cover from now all the way for 20 years later.
Okay.
Let's say the same amount. Okay. As I mentioned just now, actually our needs actually changes over time. Okay, but let's say we work on that, and you want to factor inflation. I mean, there are two ways you can think about it. One way is using a whole life plan, a $1 million coverage whole life plan, and then because every year there's bonuses, the amount goes up, the 1 million coverage will go up. That could help to mitigate inflation. Okay. However, this is a very expensive way.
Yeah.
Because to get 1 million death cover, whole life death cover is actually very expensive.
Yeah.
When you buy that, you will not have enough for your living expenses to enjoy your lifestyle, or have extra to save up for your future. So another way of doing it is basically buy a term plan. Okay, but by nature, the term plan, the death cover actually is flat from now until the expiry of the term duration. How do you mitigate inflation? Well, you could actually have some extra assets set aside. When the extra assets that can grow, the growth of these assets, safe assets or investment assets, can help to supplement the inflation effect of this term.
Okay.
Yeah. So there are various ways. At Haven, we are a strong believer of term plans because we believe that insurance is an expense. You should you should get as much as you need for insurance coverage, spend as little as possible, so that you have enough to enjoy your current lifestyle and enough to save up for your future.
Okay, because just now you mentioned about different stage of life, right? So how often should somebody review and possibly adjust to their coverage?
Actually, you don't have to review your insurance policies every year, like investments. Okay, you should review. However, you should review it every key milestones. Key milestones that actually are areas or events whereby it may change your insurance needs. So it could be marriage, newborns, even divorce or retirement. Okay, these are important stages because with all these stages, our needs for insurance coverage changes, and you want to ensure that you still have enough. All right. At the same time, beyond your needs for insurance, you also have assets that could have grown over time, perhaps bonuses, perhaps good investment returns. What this means is that with increase in assets, your need for insurance could be lesser because you don't need to depend so much on insurance. So you should review your insurance needs at these life stages to find out whether is there a need, or it could be when you are in a purchase of something expensive, like you're buying a property. So your needs also have changed. So you should also review your insurance needs then.
So then we are talking about death coverage.
Yes.
Then when someone is doing a review or planning, should we include riders such as critical illness and total permanent disability when it comes to the planning as well?
Oh yes. So that is product design, product bundling, right? But beyond product bundling, I think the first question we need to ask ourselves is what is the person's protection needs?
Yeah.
So at Haven, we look into 5 key areas: death, critical illness, disability income, long-term care, and hospitalization plan.
Okay.
So at different stages, there is a different emphasis on these 5 areas. So first of all, if let's say the person has a need for, let's say, critical illness, we typically recommend about 4 to 5 times of your annual income.
Okay.
To give you that flexibility to stop work in event of a critical illness event like cancer.
Yeah.
You have the ability to stop work for a number of years. So if that is the need that you want, that you have, you can actually bundle together with your coverage, your death coverage.
Okay. So then you mentioned about disability income. I understand that there is also total permanent disability and disability income plan.
Yes.
What are the difference?
Yeah, it is similarity, but it's very different.
Okay.
Total permanent disability basically means that this person is totally and permanently disabled. So it's a very severe form of disability. Okay. So when we think of TPD, we think about a person that is paralyzed, is bedridden, it could define as not able to function at least 3 of the 6 activities of daily living, like bathing, dressing, moving around, and so on and so forth. Or it could be defined also as the loss of use of 2 of the 6 limbs. So eyes, 2 eyes is considered 2 limbs. the use of hands above the wrist and use of legs above the ankle.
So eyes is 1, 2.
It's one eye, one totally blind and
okay.
totally unable to use a hand. One is considered 2. Any 2 of 6, definitely.
Okay.
Any 2 of 6 of this is considered TBD. So when you imagine TBD is a very extreme form of disability. Okay, the person is totally helpless, paralyzed, and in their condition. But when we think of there are lesser severe form of disability. All right, so DI it means that this person disability is not so severe. It may not be permanent. So when it comes to DI, the disability definition is not so stringent. It's actually more lenient. As long as the disability is such that it affects the person's ability to work in his current or her current occupation, the payout will be given.
Okay.
So I think previously I mentioned that the example of a teacher, if a teacher cannot perform work teaching, perhaps could lose his or her voice or couldn't stand for long. It affects his ability to earn income as a teacher. Okay, and therefore this DI plan will pay income. Pay income amount to replace a portion of the income.
Understand.
So this is actually more crucial for a accumulator than a TPD, extreme form.
So when you say DI is more crucial to someone who is accumulating, that means, let's say my age, me now, I'm working. So having a DI plan is more crucial for me because I'm working and accumulating assets.
Because your most important assets right now is your ability to earn income. Okay, so you should protect the assets of yours, the ability to earn income. So DI actually protects that. TPD is actually is often purchased as a rider. So when you buy a death cover, death insurance, usually you can just bundle a TPD into it. So it is, we should consider that because it's actually very low cost insurance to be bundled on a death cover. But beyond the TPD, if you are depending on yourself, depending on your ability to earn income, then you should get a DI, disability income plans.
Okay, then the last question I have, let's say if someone passed on, right, and they have a policy, does the death benefit, sum assured, whatever, go straight to their family member?
Okay, in the event of death claims, there are actually 2 important areas to consider. Firstly, the legal side, and secondly, the claim administration side. Okay, let's talk about the legal side. In event of claims, the insurance policies payout may not go straight to the beneficiaries immediately. Okay, so it really depends on how the policy is being structured, whether is there a will being written. So if there is insurance nominations being done, where by a plan you put the nominations, the payout will be given to the beneficiaries very quickly because it's being identified, being nominated. However, if there's no nominations done, the next step to consider is there a will written? Okay, if there's a will written, then the payout will go through what you call a probate process. Okay, to be distributed by the will. Okay. The probate process is not as fast as nominations, but it takes probably a few months for it to clear. But if there's no nominations, there's no will written, then it's intestacy, okay? Meaning that it goes through administration. So the administration will take a longer time for it to be paid out. However, insurance companies also do pay out discretionary, a certain up to $150,000 to the proper claimant. So if let's say there is the family members who come forward to the insurance company and the insurance company could access and give out advance payment first. Okay,
But they have to assess first lah.
It will go through a certain checklist to identify whether this person qualify and
anyone can go.
It's family members.
Any family members.
Yes.
Okay. Without the understand.
Of course, if the spouse, if the closest they go by the closest. If the survivor is a spouse, is as a surviving spouse, and then that could be the best person to come forward. If not, then the children. Yeah.
Okay. So you mentioned about nomination. It's not like CPF nomination, right? This nomination.
No, CPF nomination and insurance nomination are two different classes. One is
Okay.
for CPF is for CPF, insurance for insurance. So just now I mentioned that there are two areas, right? One is the legal part, and second part is the administration part. The administration part is basically about when there's a need to file it first, right? Because you don't file it, insurance company don't know. All right. So at Haven we understand that death or a claim is actually very emotional sometimes. Okay, because you need to deal with loss, bereavement, and then you need to deal with the insurance, need to deal with money. So at Haven, we actually set up a team, policy servicing team that actually looks into all these claims requirements, death claim requirements, such that if in the event of a death claim, the family members will give us a call. We will expedite the whole administration process. This is a dedicated team to look into informing the family about the requirements and getting the documents to liaise with the insurance company. Yeah, so that we could turn around the claims as soon as possible.
Okay, so truly buying an insurance is not just purchasing something. Like I would say, it also takes a lot of effort for someone to do the policy servicing and also do the claim if they have to. So at Haven, we understand that, and we have a team of members that actually help our clients with the claims or any policy servicing that they need to.
That's right.
Okay, thank you so much for your time, Eddy. Well, we have come to the end of the episode today, and this is the last episode of the series. So if you do have any questions or any comment or anything you would like us to answer in the future, please leave it down in the comment section below and like the video as well, and click the bell button so whenever we have any videos, you will be the first to notify. Thank you. See you next time.
Bye-bye.
So let's dive into today's topic. So today we'll be talking about death. Sorry. So when you say
so the milestones will be different life phases. As I mentioned, it could be.
Okay.
Cha-cha! Let's go.
What do you think?
What do you think?
What do you think? What? Just now you think.
What do you think whether inflation? Yeah, inflation is.